I will take a minute just very briefly and kind of give you an overview. For those of you that are very familiar with the all-in-one, I still feel like it's worth repeating because it's such a dense product in terms of its learning curve. So we'll take a quick second to do that. And then I'm going to kind of give those of you that are not familiar with Ridge Lending quick background about me and the company. I'll keep my resume brief for you. And then we're just going to get right into the case studies. Okay, I've got two specific case studies that I'm going to go over with you guys. I'll be sharing screen. If you haven't seen this before, it's the online simulator, interactive simulator that allows us to compare Lisa B is with us in the house. Yay. Hi, Lisa. I saw that come through. The all-in-one interactive simulator is such a cool tool that allows us to compare the all-in-one in a very mathematical, scientific way to a traditional new mortgage or perhaps an existing mortgage that you have on a rental property or a primary residence or whatever. And I always say that the math won't lie. So I think because of the density of this product and the learning curve that I mentioned a second ago, I really feel like the visual aid of the simulator, and when I'll be sharing screen, really enhances the assimilation and understanding and learning of what this is. So, and this obviously will be recorded. So any of you that want to get a copy of this, let us know. I think actually the team is going to send these out to everybody that's registered, so you'll get it whether you want it or not. Let's just very, very briefly, I'm going to take a second and I'm going to give those that are brand new to the all-in-one. What is this? What is it intended to do? How does it work in 5 minutes or less? So the all-in-one, first of all, it's called the all-in-one because this loan product marries two of our daily driver functions, okay? You've got banking, checking and savings, and mortgage. And by marrying those two concepts, it allows an individual to take control over their financial security, really. Mortgage and banking combined says that deposits, thank you, Vana, says that every deposit that's going to go into a traditional checking or savings is now attached to a mortgage balance. And dollar for dollar, every deposit, and AKA is going to be deemed as a payment, every cent that goes into a checking and savings account that has that mortgage balance is driving it down, dollar for dollar. Because this is a revolving open-ended HELOC, the all-in-one is a HELOC, probably should have started with that. Interest accrual happens every single day, 365 days in a year, based on two numbers. The first being the daily balance, and the second being a fully indexed rate. Now, we'll get into some of that in a second, maybe, but you can kind of see where I'm going with this, that if your deposits, your gross rents, if you're an investor, your net wages, your Social Security, your retirement, your dividends, your interest, your side hustle, your child support, your alimony, whatever the amount of incoming deposits you guys have that's going in and out of checking and savings, all of that is being applied to that principal balance, driving it down. So the longer our deposits from all those different sources, whatever those mean for you, the longer those deposits sit in against that balance within a 30-day billing cycle or period of time, the less interest can accrue, right? And there's an arbitrage feature here at play. Okay, so I think what I'll do is just kind of give you an easy math example. Okay, I'm going to run through this easy math example to connect a few dots, and then I'm going to move in, I think, to who we are as a company background, and then we'll get into those case studies, okay? Thank you, Christina. So let's just imagine this, okay? You have an outstanding mortgage balance of $100,000, okay? And from all sources, you bring in $10,000 a month in deposits. And let's just to kind of give you a little bit of an example and quantify this, let's say that $3,000 of it is gross rents. Gross rents, I'm saying gross rents. If you have property management, obviously that's got to come off the top because they're getting paid. If you self-manage, it's not applicable. But I want gross rents. I don't want you thinking about what's left over after mortgage payments and et cetera, are paid. These are gross rents that we have access to as investors. For those of you on the call that are investors, you want to use those gross rents. So $3,000 of our $10,000 a month are gross rents. $7,000 is from everything else. Maybe I've got $2,000 in Social Security, and my husband still has a W-2 for the difference of $7,000, right? Whatever. I'm trying to illustrate a point here. You need to, if you're going to optimize this and use it in the way that it's intended, you want all of the access to monthly deposits. Okay, $100,000 loan balance, $10,000 a month is what we're bringing in, and my expenses are $9,000 a month. Everything that's going back out the door, down to a stick of gum, is what I like to say. So my car payment and my credit card payments, my mortgage or mortgages, my food, my gas, my utilities, my cell phone bill, down to a stick of gum, those expenses in my example here are $9,000 a month. All right. Month one, day one. $100,000 is my outstanding mortgage balance. My $10,000, just to keep it easy, all comes in on the first of the month, all at the same time. Okay, I know that that's not reality. Our incomes come trailing throughout the month, but it'll cycle to be this way in the end. More on that later. So $10,000 comes in, I deposit into my checking and savings, and my $100,000 balance, mortgage balance, goes down to what? 90,000 bucks, right? My 10,000 goes in, balance is $90,000. I'm not going to touch that $10,000 for the vast majority of a 30-day billing cycle. We're going to call this 29 days out of 30 days. That 10 grand will not be touched. So for 29 days, the interest accrual, remember I said a second ago, is based on two numbers, the fully indexed interest rate and the daily balance, right? So for 29 days of this first month, my balance is 90 grand. The interest accrual is based off that $90,000. Now, throughout the 29 days, obviously our expenses are going to be due. All of those things are going to come up when they come up. So what we're going to use is that arbitrage of someone else's money, interest-free. Okay, remember I said 29 days. I'll come back to that in a second. So we're going to use a credit card or credit cards of our choosing, the ones that people say, which one do I use? Well, I'm going to say the one that gives you the most points. If you travel, maybe your Alaska card, maybe your Costco card for your rebates, whatever it is, it doesn't matter, Amazon. So the card of your choosing that's going to give you the most benefit overall is what you want to use throughout the month to pay every cent of your expenses. And in our example, we've called that $9,000. On day 30, before the credit card is going to have any interest accrual, right? That would defeat the purpose. We're not going to pay any interest on a credit card. On day 30 of our 30-day billing cycle, we're going to go online to where our $10,000 has been living, and we're going to pay off in full our credit card. So for one day a month, my balance was $90,000 for 29 days. And on the 30th day, my balance went to $99,000, right? I took 9 grand and I paid that credit card off. So for one day of that month, or let's say 12 times in a year, if this was exactly the same every month, I'm paying interest on that higher number, okay? That higher balanced number. That's month one, okay? The compounding saved interest is happening every single day in that 30-day billing cycle. That's compound interest number one, daily. Compound interest savings number two is monthly. So fast forward into month two, day one. What's our outstanding principal balance on month two, day one? It's 99,000, right? I had $1,000 of cash flow or savings from the prior month that I didn't use. So my starting balance on day one, month two is $99,000. My 10 grand comes in, I drop it into the account. So now what's my outstanding principal balance for 29 days out of a 30-day billing cycle? 89 grand, right? So you guys get the point. Probably some dots are starting to connect here. So you can see that's compounding interest saved number two, monthly. We've established the daily, and now you've seen the monthly, and that's it. It's really as simple as that. Now, even if you're sitting here thinking, okay, I think I get it, I promise you the dots, if you're still in that place where it's still kind of fuzzy and you're kind of reaching like, okay, I'm connecting this and I see that, just give it time. This is not for the faint of heart. There is a learning curve here. We'll take as much time as we need to. But I think that's a decent enough recap or overview of the all-in-one. Feel free, you guys, to put your questions in the chat. We'll get to them. A lot of this hour that we're going to spend together, I hope, is going to be for a Q&A. Okay, so there you go. There's your quick recap of the all-in-one and sort of the mechanics of it, how it works. Who are we? Ridge Lending Group. We are, I'm going to talk fast. We are a second generation company that focuses not exclusively, but very largely on real estate investor needs. We're a full functioning direct lender. What that means to you is that we will fund loans on our warehouse line. We underwrite most of our loan products in-house. That just means that we maintain most of the control. We have the ability to broker loans should it be to your advantage. I don't usually find that to be the case unless it was required, but anyway, fully functional direct lender. We're licensed in 49 states, so we have a very broad footprint. The only state we are not actively licensed in residentially, we can still do commercial here, is New York. Otherwise, we're going to be everywhere you're looking to buy, sell, refi, etc. I would also share the following tidbits, and then we'll move on, I promise. Strong value adds. I would say I'm going to just keep it short and limit it to the two that I believe are the strongest value adds that Ridge Lending brings to the table, and that's going to be diversity of loan product. We're here to talk about the all-in-one today, obviously, but we are not a one-size-fits-all. We have a very diverse menu, I like to call it, of loan programs that include the all-in-one, that include Fannie, Freddie, FHA, VA, bridge loans, DSCR loans, commercial loans, cross-collateralization. You get the point. It's very, very diverse. Very infrequently do I get a request or someone coming in saying, hey, Ridge, can you do this? Where I turn around and say, no, sorry, we don't have any place for that. That's pretty uncommon. So whatever your circumstances or your needs, chances are we'll be able to accommodate those lending needs. And then second on that list of high value adds, I'm going to say is the education. I feel like I'm an educator by heart, just it's what I like to do. I think that mortgage and real estate investing comes with that heavy learning curve, and it's not dear Google stuff, as I like to say. It's not the kind of thing that you can just plug in the question, although with ChatGPT and AI, I've messed with that myself actually recently, and even still with all of the advancements there, it misses the mark. I can trick it and get random answers very easily. My point is that if you want that financial fluidity or I think it's very, very important to understand the why behind the how. I like the details. Not everybody does. But if education is important to you and understanding the inner workings of underwriting guidelines as they apply to you and your qualifications, and then having a lender that will actually teach you from an underwriting perspective how to optimize things like debt to income ratio and credit score and assets, right? An actual look under the hood. If that sounds interesting to you, then Ridge Lending Group is going to be a good fit. So I think those are our two highest value adds. And then finally, I'll close with this. I am, I think, unique in that I am a real estate investor as well. I've held many, many properties all over the United States, so I can see it from both lenses. I'm happy to and often will add my 1.3 cents worth is how I describe it, and my clients can take what they want and leave the rest. But I've got plenty of wins and losses that I'm able to share that I think resonate and help people be more informed about what their decisions are for their lending needs. Okay, are we ready for this? Are you guys ready? I'm going to share screen. Let me make sure that my background here is the one I want. Boom. Okay. So we're going to start with case study number 1. Now, let me see if I can figure that out here. It's this one. Okay. So hopefully you guys have, I'm hoping if this is you're here for part 2, chances are decent that most of you have seen this. This is our interactive simulator. Let me really quickly show you how to find this on our website. Here's Ridge Lending Group's website. What's my problem with saying Ridge Lending Group today? Right here, all in one. And you just scroll down and there is the simulator. It'll take you right to the getting started. Okay. So feel free, you guys, to mess around with this for your own circumstances. All right. So what we're talking about today is for those that either have an all-in-one already or they want that second layer of, okay, if I do this and I get into this, how do I apply it? How do I use this tool to maximize what my goals are, right? My financial freedoms. So what I've done is I've taken a case study. These are longtime clients of Ridge. I got their permission to do it. Ron and Jen, VIPs, actually, we've done many, many loans for them over the years. This is their profile, okay? So they came to us about, I think it was 3 or 4 months after a refinance during the pandemic rates. And I love this example because it really illustrates the point in that interest rate where most people get fixated is not irrelevant, okay? That's not what the following commentary is meant to communicate, but it is so much less relevant than psychologically we give interest rate credit for. Okay, so Ron and Jen, they refinanced their primary residence when those ridiculously low rates were available to us during the pandemic. And within about 4 months of having that loan, we refinanced them into this product, the all-in-one. Okay, these are the numbers at the time. So their home was valued at, well, do I want to go through? I'm not going to take the time to go through the setup here right now. You guys can go watch the first one. I went through all of that and why you would select certain drop downs, etc. We're just going to get into the nitty gritty because I want to save us time for the Q&A. So their home was valued at 1.2 million. At the time, they owed 435,000. They got a 30-year fixed mortgage at 3.25. They just had it for a few months. This is their principal and interest payment at the time, given these variables: 3.25, 435,000. It was this old. That was principal and interest. Okay. Collectively in their household, they're bringing in $26,000 a month of income from all those sources that I keep mentioning. Okay, and I just lumped it all together. Certainly the simulator will allow you to add additional repeating deposits if you want to break it up into husbands and wives and other people in the house, or between rental income and ordinary income, whatever you want. I just like to do it this way because it's easier and faster, and I get to choose. Second here, you're going to see on the screen a one-time deposit, right? Repeating deposit and one-time deposit. I usually leave this blank to start with. Not super relevant to this case study in our conversation. If you have idle cash, I just want to fill in the blank though for you guys. For those individuals that have a substantial amount of money, and that could be $5,000, it could be $500,000, whatever the number is, if it's sitting in a 0 to low interest bearing account, I mean, if it's in an account earning 4, 5, 6, 7, 8%, you're going to need to do the math. Okay. But if it's not, and it's just sitting idle, you've got this safety slush fund that you like to keep on hand that's doing nothing for you in this FDIC insured account, you absolutely are going to want to pull it from that vehicle and put it into this FDIC insured account. Okay. I'm not doing that here, but that's what that one-time deposit is. Or here's another example real quick. Let's say that you're going to get like clockwork. You get a $20,000 bonus in December every single year. You could, if you wanted to, forecast and say $20,000 in, what is that, 3 months? Or you're going to get a tax refund of $5,000. It's been on average $5,000. You could say $5,000 in 8 months, whatever it is. Okay. Getting rid of that. All right. And then you can repeat either one of those, repeat and one time. Okay. Ron and Jen, there's their $26,000. There's their $1,902.55. The taxes and insurance on this property are $950 a month. Their monthly expenses of this $26,000 or $15,347. These individuals are able to set aside $7,800 of their monthly deposits. That's their residual income, their discretionary income, their monthly savings. Those are both just fancy ways of saying that's their cash flow monthly. That's what they have left over after everything goes back out the door on average. Okay. The simulator assumes the following. I want to take a quick second and make sure that I'm quantifying this so that it's clear. Okay. Because this is important stuff. Here are the assumptions to the following results. And this is it. This is all the intake that it requires. No vials of blood just yet. If you haven't seen this before, very easy intake. You don't have to go through a ton to get the results that you're just to see if you're a good fit. So the assumptions in the simulation are that $26,000 is coming into this checking account where their 435 lives. Okay. 26,000 is coming in. It's going to sit there for how many days? 29 days out of a 30-day billing cycle. We are not going to touch that. It also assumes that this number that was going back out the door to pay PennyMac, okay, 1902, is now not going back out the door to pay PennyMac. We have replaced PennyMac with the all-in-one. So that assumption in the simulator is that 1902 and 55 cents is now going to stay in the all-in-one. It's not going back out the door, and they're not using it for some other living expense. Okay, it's staying idle here. If they needed to access it for any reason without question, they could do so 24/7. Okay, the next assumption is this is going back out the door, right, on day 30, and that this $7,800 is also left over. So 26,000 sits idle for the vast majority of the month. This goes back out. Obviously, tax and insurance go back out, but 1902 and 7,800 are left in the account. Now, I want to show you guys one thing here. One-time future expense. Now, this will be relevant in a minute when we get into the second case study. This is where I'm going to be able to show you how you're going to utilize this product In this case, I'm using it from an investor standpoint that may or may not apply to any or all of you, but this will allow us to forecast. Oh, I left that in here, didn't I? Hold on a minute, please. Oh, I did. Sorry. Okay. So it's actually in here. So my apologies. So what I've done here, so Ron and Jen, I'm going to come back to this, you guys. You'll see why in a minute. So maybe just remove that from your brain just for a second. I'll layer this back in. Let's go look in our, let's go check out our results. Okay. Left side is the all-in-one. Here is our comparison loan that they had just gotten at the time. 435,000, 435,000. Those are the principal balances, right? Total interest here is 117,000 and change versus that 30-year fix at 3.2 had 244,000 left in interest. 76 months, that's just the sum of 6.3 years times 12 months in a year. That's what that is. Over here is 357 months. The sum of the top two numbers is here. Total expenses, 552 and change, 679 and change. And then the difference between those two numbers, total expenses, is here. So Ron and Jen stand to save almost $127,000 of interest on a 3.25% interest rate, 30-year fixed. So this is a great example of, for those of you that are fixated on your pandemic rate of 2.5 or 3, whatever the number is, I really encourage you to try and remove that psychological stick and do the math. Do the math. The math won't lie, okay? So these are their numbers, all right? 6.3 years to pay off. What else we have done, and the second layer to this in the case study too, is to show how Ron and Jen were able to utilize this loan product, this tool, and perpetuate or excel their financial freedoms and wealth by utilizing a line of credit to purchase additional investment properties. So let's go back and to that last screen that I jumped away from, and let's look here. So what they had done is every 10, 11 months, they picked up another investment property, and their model is about a $250,000 purchase with 20% down, which of course is about 50,000, but closing costs, and then keeping, $5,000 off the side in reserves for each of the properties. They're quite conservative. I may not have an extra $5,000 for every property that I buy. I think that might be a little bit high on my level of risk when I'm buying investment property. Anyway, whatever. The point is that 65,000 is what the assumptive expense was in month 10, in month 21, and in month 32. Okay, so during these times, they were able to draw this amount of money from this line of credit and acquire 3 investment properties. As a result, these numbers represent the same thing. Okay, now the 3 purchases, they had to get financing. They got 3 30-year fixed mortgages for each of those investment properties at $200,000 a piece. And that's what the second case study is going to be. We'll get there in a second. So 6.3 years, they paid off $435,000, and they were able to acquire 3 investment properties. Okay. Michael, do you feel like we should stop or pause for a Q&A real quick, or should I just move into the kind of the part 2 and then open up? Any thoughts on that? What do you think? Do we have a lot of questions?
Yeah, we have a few questions that would be good to address.
Okay, okay, let's do that.
Yeah. So a common question that we get is, what if we already have a HELOC with a bank? So this is maybe a fundamental question, which will play into why this program is a bit different. They already have a HELOC bank. What options are available to them?
So the question is, if they have a HELOC, what options can they use? I think maybe, and please feel free to unmute yourselves, you guys. I think that you're asking, can I use this HELOC in this fashion? The answer is yes. The all-in-one concept is unchanged, whether it be a first lien or a second lien. So the individual that asked that question, if you have a second lien HELOC right now, I will tell you that your access and overall advantages are going to be diminished with a second lien versus a first lien. There's only one category where a second lien, there's only one advantage, okay, that the second lien HELOC might have over the all-in-one first lien. And I'll come back to that. But to answer your question, 100%. it's going to work in the same fashion. An open-ended revolving line of credit is what you need in order to achieve conceptually what this all-in-one can do. Now, whether your interest is for interest savings or future growth or a combination of the two, or having just access if something comes up in the future, college for kids, or I mean, it's limitless, really, the advantages. The second lien will work. You're just not going to have the same access as the all-in-one. You're not going to have the banking features. You're going to have to do it all manually. The line limit is going to be diminished in second lien position over first lien position. So the easy answer is, yeah, man, second lien HELOC absolutely will work in this same exact way. It's just not going to provide all of the additional advantages that the all-in-one does. And maybe I'll get into kind of once I've got some bullet points that Michael has asked me to go over after we get through the case studies, and maybe anyway, maybe I'll address some of that more.
Can I distill that down to my 5th grade level? Just because
Yes.
I think that one of the challenges, like you said, conceptually, it technically can work, but humans are subject to human nature. And if you're not driving all of your income, this is what we find, and this is what I found with my dad, who got this mortgage as well. If you have an equity line of credit and it's not automated that all of your income goes into this account and you spend your money out of that account and you pay it with a credit card, if it's not an automated system, what we find is that people aren't actually executing on this, and therefore the benefit goes away.
That would be one layer of loss of benefit, 100%, Michael. Just to 100%. Okay, the automation part, most people are not going to either have the time or take the time to manually shuffle the funds back and forth the way that they would need to be utilizing just a second lien. That's one of the primary reasons that it's deficient. A second lien will be deficient in relation to an all-in-one. But mathematically, if your question is, can you do this with a second lien? Yes, you can.
You can. Yeah, you can technically do it. Now, the other piece you mentioned, which I think you know this product so well that you can talk about it quickly, but I'm trying to understand at the same time as you're talking. But one thing you mentioned was your access to the equity is different. When the reason why we see that is because with an equity line of credit, typically it's like a 10 or 20% equity line of credit. And then you have a fixed rate, close-ended first mortgage. And so to use this product the same way as you would use the all-in-one, you would have to draw down on your equity line of credit, spend your money, pay it back, then take a chunk, drop it into your primary mortgage, and now that money is locked behind a close-ended instrument. You can't get it back
100%.
without refinancing.
Yeah. Does the individual that asked the question, does what we're talking about here, is that answering your question? Is it resonating? Are you getting the answer that you were expecting or needed? I'll wait for that person to respond. What else we got, Michael?
Most of the questions are actually tied to that.
Yeah, maybe we can take more time if you
but we
think.
have a couple people saying that, yeah, that clarifies
Okay.
the question.
There's more to that sentence. There's another, I mean, to complete that sentence, there's more reasons that the all-in-one I think is superior. The only reason that a second lien HELOC would not be the superior of the two would be cost. And if you have it already, then there's no cost. Second lien HELOCs are very, very inexpensive. And we'll probably get into this a little bit later in the Q&A. The all-in-one is not a cheap loan. I mean, just to kind of get that part out of the way. However, when you do the math, you guys, I believe you'll find that it's more than worth whatever you're going to pay for this thing. And I'm not saying that just to earn some one-off commission. Okay, that's not what we're about. I'm about relationship and educating the masses. Sure, we're going to get paid when we close these loans, but that's not my intention in providing that statement. The all-in-one is not cheap. It's worth it. If you're very, very cost sensitive and you want to try and do it on your own with a second lien, the answer is yes, you can. I think you could be better served looking at the math, at least take the time to do the math on the all-in-one. Anything else in there before I move on to the case study number 2?
No, it looks like Craig does have a question, but it's tied to number 2, which is when you buy additional properties. So
Okay, let's get after it. All right, so I'm still sharing screen, right? Let's go back in here. Okay, so we understand this is part 2, you guys. So I'm not drilling down into some of these subtabs the way I did on part 1 and the way I would on a one-on-one consultation. Okay, so for those of you that want that, make sure that you go through our masterclass. There's a little bit of skin in the game that we require. It's nothing crazy, but if you want to get some one-on-one time with me and do this simulator together, you got to go through our all-in-one masterclass. Probably take you 20 minutes. Okay. Case study 2. Well, case study part 2. So what I've done here is I've taken that $600,000 of debt that those 3 purchases, remember we talked about over here, this guy right here. So Jen and Ron bought 3 investment properties. Okay, $250,000 each. They put 20% down, etc. So we have $600,000 of mortgage debt for these 3 rentals. All right. So I wanted to simulate and show you guys. So, and remember, this is 6.3 years. And it's been about 4 years. So they've got about 2 years left in their scenario here. But then what I wanted to show you is that once that's done, taking that $600,000 of mortgage debt for those 3 rentals in particular, they were able to accelerate the payoff of those mortgages utilizing this line of credit. Okay, now their line of credit was $960. Their initial draw was $435. Okay, but we're waiting, and then the payoff of those 3 mortgages is going to come in about 2 years. They're going to just stroke a check for $600,000 and pay all of those off, and they're going to house it inside this all-in-one line of credit. So as a way, it's not set up as a mortgage for cross-collateralization. You're never going to get one all-in-one mortgage that's going to blanket cover multiple homes, right? That's recorded with the county as a lien. But we can manually cross-collateralize because they took the line of credit that's on their primary residence. They paid off their first mortgage. They bought 3 properties. And in 2 years, they're going to pay off those mortgages that they got. I think 7% was the average interest rate. You'll see that in a second. They're paying this $600,000 off in 4.3 years. So when you look at these, and I'll go back through the setup here in just a second, but when you look at the 2 in this bigger picture, they paid off about $1 million in debt. They have 3 rental properties as a result, all within a 10-year period of time. And they saved, you'll see how much interest they saved in a second. So let's just start back here. So this is the line of credit that they received. Okay. This is what they're stroking a check for in about 2 years to pay off those mortgages. 7% is the average rate. I think a few of them, I think I increased this. I think the blended average was like 6.875. So I just used 7 to make it more conservative. Okay. In 36 months, age of loan, this is 4126 would be the simulated principal and interest on the mortgage debt that they've had those mortgages during that period of time. Okay. Hopefully that makes sense to you guys. If you have questions, we'll answer them in a minute. Same here. 26,000 is what's coming in. There's their taxes. We have a little bit more cash flow. Okay. Before we had 7,800. Now we've got more cash flow because these are being paid off. Those mortgages are being paid off to 0. So now we have 3 free and clear properties. Oh, let me check one thing. Hold on, guys. Yeah, just making sure. Hold on. When you remove it, it changes our fields. So now we've got 4.3 years to pay off this $600,000. There's the total interest compared to what they were going to pay, et cetera, et cetera. They stand to save about $622,000 worth of interest. Now, let me say one thing about this, okay? This number looks sexy as hell, right? $600,000 of interest savings. This assumes that Ron and Jen were going to keep those 3 mortgages, those 30-year fixed mortgages, for 30 years each. And I want to be fair about this in that the chances of anybody, not just them, but of anybody taking a 30-year fixed mortgage and stroking 360 payments to make it a 0 balance is a fraction. And I don't even care what your starting interest rate was. The percentage of people that are going to take a 30-year mortgage and pay it to 0 without ever refinancing to harvest equity or to reduce an interest rate or selling to upgrade or downgrade or into a 1031 exchange if it was a rental property is a fraction of a percent. The average shelf life on a 30-year fixed mortgage ranges between 5 and 7 years, depending on occupancy. Why am I telling you this? I'm telling you this because this number looks amazing, but in reality, no one's going to pay for 30 years on a mortgage. It's very, very, very rare to see that happen unless you're much, much later in life. Now, I'm not saying there's exceptions to every rule. Of course, there's people that do that, but it is a very, very small percentage. However, let me finish that sentence because what you're hearing me say is that this number may not be real. It absolutely is real, maybe even low, because a 30-year fixed mortgage, if anyone has ever in your spare time looked at an amortization table of a 30-year fixed mortgage, you're going to have seen that the first 10 years of that 360 months or the first 120 months, how much of your payment is going to principal? Very, very little, right? It's meant to happen that way because they want their money. The secondary markets, the investors that are putting themselves on the line to ensure that this is a good investment, right, against default and all the other risks that they're taking, they're going to front load. They want their interest. So a 30-year fixed amortized mortgage helps the consumer in that it keeps the payment nice and low, but that interest is front loaded. So if we're going to be refinancing this every 5 to 7 years, what happens to the clock? It starts over again, right? So this number is actually maybe a little bit low. And I just wanted to make that point and illustrate that. Maybe a little confusing, but if you guys have questions about it, that's fine. Anyway, I don't think that there's much more that I can illustrate that highlights how powerful this loan product is, how substantially impactful this can be for the consumer. You have now created that environment that I always say that you're your own bank, right? You have become your own bank and you now get to choose and are in control of largely how much interest is going to be accrued over time. But I think more importantly, the interest savings is amazing. Okay. And in this example, I chose one that was really, starstruck. This is a very, very good example. This isn't always what we see. Maybe it's 50,000 in saved interest. Maybe it's 100,000. Maybe it's 20,000. That's all well and good, and it's fantastic. But for me, I think the real value add with this product, and I hope that we get into some of the Q&A about it, is the access that this provides you and the flexibility that this provides you for any reason that may befall you in your life, whatever that may be, real estate investing or not. This is your line of credit to do what you want, when you want, how you want, without question, without qualifying. Once you have the line, it's yours. And by the way, it's a 30-year line of credit, which is one of my favorite features about the all-in-one. Okay, let me just take a quick second before we open up. What do we got? Okay, we got 20 minutes. Before we open up for the Q&A, let me just go through a couple of these quick bullet points to highlight some of the advantages. I guess I just started on that, but let me finish the thought. So maximized cash flow and interest savings. We just talked about the interest savings. It can be ridiculous in the profound sense, okay? So that's obvious. When you guys run your own scenarios, you'll be able to see what that looks like for you. But maximized cash flow, right? You've got the flexibility to fund renovations, emergencies without new loans or those approvals that I talked about, functioning both as a growth tool and that personal safety net. Let me add one. Actually, I think that it comes up. Do I say that later? Hold on. I've got some notes, you guys. Safety net. No, I think that's right here. So let me give you some examples of safety net. And I don't usually get a lot of time to talk about this part of it because there's so much else to unpack. So I want you to imagine for a second, I did a video with a real estate guy back in February or March of this year, and it went viral. It was my first time going viral. Anyway, I think that the tagline that he had put on there when he published it on YouTube is what got people's attention. And when this statement was first said to me, probably 18 years ago now, I was almost irritated by it. Stay with me. I'm making a point, I promise. So there is no payment due on the all-in-one. And again, when that statement first came across my ears, I was like, come on, man, shut up. What are you talking about? That made me even more skeptical about what this was when I was first learning about it. There is no payment due on the all-in-one. Question, what happens on your 30-year fixed mortgage or any traditional mortgage? What happens if you don't make a payment? They're coming for the keys, right? You're going to be foreclosed on. You're going to trash your credit. That's an amortized, scheduled mortgage. This is not what this is. This is an open-ended revolving account, okay? The reason that that can be true is the following. So long as there is a margin between the balance, what you owe, and the limit, if you chose to, and I'm not saying you would choose to do this, I'm not saying you should do this, I'm telling you as that safety net piece, and kind of, I'm going to create a scenario here for you guys to track. If you chose to not make 1 cent in deposit into this account, as long as there's a spread between what you owe and the limit, all that's going to happen is interest is going to accrue on that balance. Example, let's say that you have a $100,000 balance and the credit limit's $200,000. Okay, just for easy math. Let's say that you lost your job. Let's say that something happened and you had no means of bringing income in. All of your tenants stopped paying and you had no income coming in, etc. Well, the first part to this would be that if you didn't make a deposit into the account, the only thing that's going to happen is that $100,000 balance in the next month is going to be $102,000 or whatever the interest accrual is for that past 30 days. Okay. Now take that a step further. No money's coming in. I have bills, man. I got to feed myself. I got to feed my family. I'm going to draw $5,000 to live off of for the next 3 months. Okay. So now my balance has gone from 105 to 110 to 115 plus the interest accrual along that way. As long as there's a spread between your balance and the limit, there's availability there. That's your equity, right? Talk about turning yourself into your own bank. So as a means of protection and security, if you ever needed to use it for that reason, that would be at your discretion. So it's one of the more profound advantages of this concept and strategy that I don't get a lot of time to talk about. Okay, next up, liquidity and access to capital. Obviously, we kind of touched on this earlier. So it's instant access, you guys. Those pre-qualifying, the closing costs that you would be paying every time you want to harvest equity or tap into that equity, whether you're using it for down payments, if you're an investor, renovations, acquisitions. No, you won't need a bridge loan if you're doing a fix and flip, perhaps, if you have enough available. Your kids need college tuition, or you got to buy a new car, or whatever. I mean, let your imagination run wild. Whatever, you have access to it without question. Okay, portfolio growth and scalability. So it enables, I kind of just said a little piece of this, it enables investors to recycle equity quickly into new deals. That's velocity of capital, right? You're constantly churning. This is a big play for the fix and flippers or even fix and holders, right? You're not having to worry about competing in hot markets for cash buyers. You don't have to pay carrying costs for those bridge loans, et cetera. Scaling into larger deals or joint ventures with outside partners, perhaps, it can create a competitive edge by giving you that cash on hand flexibility to seize opportunities. Okay, so those are some of the bullet points for advantages of the all-in-one. Let me just now be quiet and open up for whatever your questions are. What do we got, Michael?
Yeah, we got lots of great questions here. I'll just start at the top. So the first question here from Kelly is, do we do all-in-ones, or can you get an all-in-one on commercial rental properties, specifically 5 units?
Good question, Kelly. Unfortunately, the all-in-one is reserved for residential only. So it's going to be single family up to 4-unit max. There isn't one for 5 and above, or otherwise commercial, storage or something like that. It's got to be residential.
Yep. We have a great question here from Leslie. She said, so instead of doing a BRRRR for each rental property, do you recommend getting the all-in-one as a refinance versus traditional cash out refinance?
Yeah. Hi, Leslie. Yes, absolutely. And the reason that I say that with such conviction, you guys, is because, and I'm not saying that there aren't circumstances where a straight 30-year fixed cash out refinance might not be appropriate or even better than the all-in-one, but more often than not, I think that the all-in-one is going to be the play, because unless you're ready to deploy that cash immediately, and unless you can't qualify, or unless the numbers on the all-in-one don't make sense for you, a straight cash out refi, you're getting those monies right now. all of them, and you're paying interest on them right now. Even if you're not going to deploy them for a month or 2 or 3, the all-in-one is so versatile in that you're never paying interest on monies that you're not using. So, right, if your balance is 100,000 and then you need another 50, but you don't need it for another 3 months on the BRRRR, for those that you don't know what that is, buy, rehab, rent, refi is what BRRRR stands for. It's a methodology within real estate investing. So I'm not saying that a straight cash out refinance is bad or not warranted in certain circumstances. I just think more often than not, the all-in-one is going to be the better play.
Okay, yeah, that's great feedback. Kevin had a great question here. Said, in the example of purchasing the 3 additional investment properties from your case study here, at 65,000 was pulled out to utilize to close on the investment properties, and if so, would the remaining of the 15 to 30-year mortgage be held in the all-in-one product, or is that held in a different loan?
Good question, Kevin. No, those were 3 individual loans. So, however, after the payoff of the 435 original draw, when they first got the all-in-one 4 years ago, once that happens, it's 2 years from now, we are going to take that line of credit and we're going to pay off those 3 Fannie Freddie 30-year fixed $200,000, $200,000, $200,000 mortgages. So those 3 properties were acquired by using $65,000 down payment from the all-in-one and a 30-year fixed Fannie Freddie loan. Does that answer your question?
So the goal is to get that primary paid off, then pay off those rentals.
All of them will be paid off in 10 years. Yeah.
Yep. Cool. Randy asked, because this isn't a traditional mortgage, is there any difference on how loan officers look at the all-in-one versus traditional mortgages when applying for a new loan to obtain another rental property?
Good one, Randy. Very good question. Yes, and it actually is probably not the answer that you're expecting. So I think I'm going to say it a different way, Randy, so that those that may not have followed that might pick up on it. So I believe, and tell me if I'm wrong, Randy, unmute yourself if you want. I think you can. What he's asking is that I just got an all-in-one mortgage, okay? And I just got an all-in-one mortgage, and on my investment property, and I'm going to go buy 2 more rental properties in a month or 6 months or whatever it is. When I go buy those new purchases, are my qualifications and the way the lender is going to look at that all-in-one loan going to inhibit me or preclude me from qualifying over here? Right, Randy? I think that's what he's saying. If not, then you tell me, okay? In which case the answer is no. And chances are it's actually going to work to your advantage. And here's why. So for qualifying for the all-in-one, it's pretty rigorous. And if you guys have questions about that, I think we'll have time. I'll answer that in a second. But once you have the all-in-one, this is an interest-only loan. So, and it's based on when we pull your credit. Okay, so we got the all-in-one for Randy, and 2 months later, he's buying an investment property. Okay, and let's say that the credit report that we had prior is aged out. We got to pull another credit report. So we pull the new credit report for him, and the all-in-one is listed on there. It's an interest-only payment. And it's based on the day that we take that snapshot of credit. So the balance, we can actually be strategic about this. So let's say that his balance on the all-in-one was 150,000, but we thought that DTI might be a little bit tight and he had some extra cash. So I told, actually, no, he was able to liquidate. This is a little bit convoluted. He put an extra $50,000 into that account and took his $150,000 balance on the day down to 100,000. Okay. The calculation when we pull, when that credit is pulled, the calculation is based on the balance and the interest rate, and it's interest only, which is a very simple calculation. By the way, I'm going to take you guys through it really quickly. I want you to do me a favor. If you have a calculator, take $100,000 times 8.35%. That's the fully indexed rate today. $800,000 times 8.35% sign. You're going to get 8350, right? Divide that by 12 months. 695 is what you should get if you did it right. The interest only payment is calculated that way. So instead of it being a fully amortized principal and interest payment, whatever the interest rate is, it's an interest only based on the balance on the day that we actually pull the credit. So debt to income ratio would probably fare better with the all-in-one than it would if it was just a traditional 30-year fixed mortgage. That might have been a little bit heavy for you guys. Randy, if that didn't make sense, tap me and we'll go over it one-on-one, okay? Next.
What are the typical LTV limits?
Randy, sorry, I think Randy was going to
Oh,
talk.
did Randy? Yeah, Randy, feel free to unmute yourself.
Yeah, no, I said that makes perfect sense. Thank you.
You're welcome. Good question. LTVs, Michael?
Yep.
Okay. So there's going to be differences in the loan to value or LTV based on occupancy and based on transaction type. And transaction type is going to be purchase or refinance. If it's a refinance, is it a cash out refi? Is it a rate and term refi? So there's going to be variance depending on, you know, which of the characteristics apply. So let's start purchase. Purchase of a primary residence will let us go to 90% LTV. If it's an investment property, 75%. On a refinance basis, primary residence is 80% LTV. Second home is applicable, 80% LTV. And if it's a rate and term refinance, 75% on a rental. If it's a cash out, 70% on a rental. Let me quantify, what does cash out versus rate and term mean? Rate and term means that the spread, the starting spread between the balance, what you owe, and the limit cannot be, or it's got to be $2,000 or less. You basically owe what the line limit is. Then you can go to 85%. If it's cash out, that means that the spread is more than 2,000. Example, if you have a balance of $100,000 and your limit is 125, that's a cash out refi. That spread is more than $2,000. So 70% cash out, 75% rate and term on a rental. This is refi, or 80% on a primary residence or second home.
Perfect. What are some KPIs to keep track of for deciding whether you should scale?
Whether you should buy investment properties?
I'm guessing that's what he's saying, but maybe you can unmute if you or clarify.
Key performance indicators, by the way, for those that may not be familiar with what KPI is. Who asked the question?
B.
Hey, B, where you at?
We can move on until he can
Okay.
clarify if you'd like.
Okay.
Okay, so do all properties have to be under the same name of ownership, or I'm able to use my primary residence in my personal name to my investment portfolio, which is in a business entity?
I'm not fully tracking the question, but I can tell you that as entities are concerned, you cannot close the all-in-one loan in anything other than an individual name, okay? The second part to that would be, chances are you're going to say, well, what about asset protection? Can I quit claim it into the LLC or the entity after closing? If it is an LLC, the loan documents that you sign stipulate that you will not change title ownership. I think that there are plenty of people doing this. I'm not giving you that advice. I'm not an attorney, and I'm not giving you legal advice. You specifically are signing a legal document that says you will not change from an individual name into an LLC. Does it happen? I believe so. I have been told by other people that has happened. However, if you're okay with a trust, as long as it's a revocable trust, that's absolutely acceptable. At closing, if the trust has been approved, you can close in the name of the trust versus your individual name.
Luke wants to know, why is this an expensive loan? Does the lender view it as risky?
That's a good question, Luke. And I think it plays into the loss of revenue and interest that would otherwise be received with a traditional 30-year fixed mortgage. And knowing that you're not going to, chances are you're not going to be refinancing this every, 2, 3, 5, 7 years, right? So the loss of that, the closing costs and the interest, obviously, is greatly diminished. So yeah, the other part of it is it could potentially lead into some risk. Because for the wrong individuals that get their hands on this, let's say they qualify, and for all intents and purposes, they look like a really good candidate for this, but maybe they're not as responsible with their finances, and they see this line of credit as just kind of their open checkbook, and they can get in trouble. People have and could get in trouble. So risk of default, maybe within the algorithms of whoever is judging that. And there's something called an LLPA, you guys. It stands for loan level price adjustment. I won't go into all of that, but there may be risk, I think, Luke, perhaps. But I think more than that, it's about loss of revenue for secondary markets and investors, et cetera.
Makes sense. Let's see. Any tips for those of us who have the AIO but need to leave some funds in business checking accounts to avoid commingling funds to maintain corporate veils of their LLCs?
I like this question, and it's such a good question. And commingling, unless it's a trust, here's my opinion. Okay, and I've asked CPAs this. Let me just say, to cover my ass, okay, I'm not an attorney. I'm not giving any legal advice here. Unless it's in a trust account, unless the funds that you're talking about are in a trust account that need to be secured for the consumer, I do not believe that the commingling is the issue that a lot of times it is made out to be with CPAs and tax professionals. I think it's more about them not wanting to have to go through and do the accounting and seeing how, it's messier. I think the way around that, I have been given advice, the way around that is as long as it starts in the business account, they have the accounting to so it started there and it ends there at the end of the month, I think you're perfectly within right. And I would press on someone saying otherwise to take it out and at least 28 days instead of 29 days, or instead of it dropping in there originally, pull it from where it started in the business, stick it in here, let it ride, and then put it back out for their accounting purposes, and they'll be able to see how all that played. That's how I would do it. And if your CPA or somebody else is telling you that you can't do that, I would want to know why. I mean, myself, I'd be curious to know what their answer is. I have yet to have someone give me any legitimate reason that what I just described would be a problem for the IRS or commingling, as they would say. Anyway, that's my answer. I think that probably made sense.
No, legal disclaimer, we're not a CPA or a tax attorney.
Thank you. Thank you.
Craig has an excellent question here. He says, if I'm about to close on a new residential property and my long-term goal is to secure the largest all-in-one loan possible, does it make more sense to, one, purchase the property in cash now than wait about 7 months until my financial picture improves before refinancing to an all-in-one loan, or two, move forward with the all-in-one loan right away, but accept a smaller loan amount based on my current financial picture?
Because you don't think you'll qualify for the larger. I would like to discuss specifics with you. I mean, how much lower? Because if you had to choose between refinance and purchase, I say go purchase all the way. You got 90% on a purchase versus 80% on a refinance. But if the 80% refinance is on 2 million versus the 90% purchase is on $1 million, wait, you know what I mean? I'd need to know what the numbers were for that. And then I think we could come up with a pretty clear answer.
Yeah, you'd want to also look at closing costs twice.
True. No. There wouldn't be, if you paid cash, there wouldn't be closing costs twice.
Oh, that's right. That's right. Yeah, cash. Yeah, you're right.
Yeah.
Cool. Let's see here. Is there a different application process for trying to qualify through asset depletion?
No, the application process is going to be the same. So for those of you that aren't familiar with asset depletion, the all-in-one is, this is probably a good segue into the qualification metrics. I don't know, residentially anyway, of a harder loan to qualify for. This loan is very, very hard to qualify for, and there is brain damage. So anybody that has gone through it, feel free to share your experience. But anybody that's thinking about doing this, I want to prepare you that, there's going to be, at least weeks, maybe months taken from your full life cycle as a result of this freaking loan. Asset depletion, though, is when, let's say, the income that we're able to use, which is very scrutinized, any variable type income, which could be a Schedule E, a Schedule C, K1, bonuses, overtime, commissions, anything that is subject to change, right, is very strictly scrutinized. It's a 24-month average. Unless the most recent year is in a decline, then it's a 12-month average, et cetera, et cetera. So it's a tough underwrite. However, as that, let's say that whatever income we are able to give you from the documentation that you've supplied us falls short of the debt to income ratio threshold, which is 43%. Let's say that we're at 46% DTI with just the income that we've been able to show. But this individual has substantial assets in an appropriate type of account. If it's like restricted stock, we can't use that. There's certain things we can and can't use. Most of it, if it's liquid enough, we should be able to use it. 401k, we should be able to use it, as long as your terms of withdrawal are acceptable. Anyway, you can take the face value of that asset and divide it by 120 months, and whatever that number is can be added to the income column when we recalculate debt to income ratio to get us down below that 43%. I know that was probably TMI, but you asked.
Yeah. We have an awesome question here, which is if someone has an existing all-in-one and their property appreciates, would they have to refinance the all-in-one to increase the credit limit? If so, what would the process be just as hard or easier than the initial application?
It's full of refinance, unfortunately. So you're not going to get like a reevaluated property and then an increase in line limit if the property appreciates. It's a full entire refinance. It's a good question. Will it be easier if you already have one? I'm going to say no. I don't think so. I think that you're going to be put through the same exact paces. I mean, maybe no, I think it's going to be just as hard. If it ends up being easier, then you're welcome. I don't think so though.
Maybe the only thing that's easier is you expect it in advance, what it's going to be.
You know what to expect. Yeah. Right.
Yeah. Can you request updated property appraisal in the future? Oh, never mind. This is the same question. Kevin basically has the same question. Okay, so that's normal. Let's see here. I think that's all the questions, unless you want to unmute yourself and ask something now, everybody.
Come on, guys, don't take it easy on me. What do you got? No quite. And by the way, for those that have not heard me say this before, if you're sitting here thinking, I don't freaking get this, I just don't get it, and you're just kind of getting into it, I've been in finance for 25 years. Okay, I know what I'm talking about at this point. When this was first introduced to me, I'm often quoted as saying, I had to look at this damn loan for weeks, constantly on end, before I really understood and was able to connect the dots. So please, if you're new to this and you have questions, no, there is no dumb question. I promise you, I've asked it. So if you guys, would otherwise not say so, trust me, ask. That's what I'm here for.
Mark asks a question here, is cross-collateralized all-in-one possible?
Traditionally, no. However, Mark, it is manually allowed and very viable. In fact, I don't know when you joined us, but the second part of the case study where they bought the investment properties over a period of 3-ish years. They were then, after the payoff of the initial draw, they're going to pay off 3 mortgages, and all 3 of those mortgages are going to be housed in the one all-in-one. So technically, it is a cross-collateralization in that all of that debt is going to be housed over here and accelerated to pay off quicker in the same fashion that the all-in-one works. Now, those 3 properties are unencumbered. They're free and clear, but the mortgage debt is all in here. You're never going to have the all-in-one loan that will encumber multiple residences, but you can manually do it that way. It's your line of credit, right? You can fund whatever you want on that line of credit, and that includes paying off other mortgages.
Any final questions, guys? We will be providing a copy of this to everybody who attended, so be on the lookout for that. And then while some of you gather your final thoughts, we also wanted to make sure that you are aware that we have a special offer for those who have the all-in-one mortgage already, as we are launching a new community for all-in-one investors. The feedback we receive from the people we close loans for is that they wish that there was somebody that they could bounce ideas off of, deal structure ideas, how to leverage the all-in-one on another level. So we're going to be adding a new private forum to our community, which you can find at ridgelendinggroup.com, which is strictly for all-in-one mortgage customers.
Yeah,
And
it
so
should be
we will-
cool.
Yep.
That was a very good
It is
idea.
stood up and ready to go. There are 0 people in that. We'll be inviting everybody who we've closed loans for in the past, though.
Yeah, that was a really good idea, Michael. Yeah, we did a survey and the feedback was, oh my God, yes, please. Because once you, excuse me, sorry, once you have this loan, there's still, and we're always available, obviously, but it's nice to have access to others that are using it on the day to day and may have, thoughts or advice. Anyway, so that'll be cool. I'm excited that we're doing that.
Couple
Any other
final
questions?
questions here if we got
Okay.
time. Yeah.
Yeah.
Do they look at your age when qualifying? What if I'm a high income earner but want to retire in 5 years? Will that disqualify me?
How old are you now? I think you got to be 18 to get the loan.
No,
But
oh yeah. Go ahead.
well, the fact that you're going to retire in a couple of years, that's your business. Maybe I'm misunderstanding the question. Say it again, Michael.
He just basically asked if they look at your age when qualifying. I think maybe Randy's in retirement years and thinking that they would legally they can't discriminate against you.
Yeah.
So
Not happening.
Does the mortgage allow for portfolio insurance policies?
Ooh, good question. So the property is part of a bigger policy, right? The policy, you've got an umbrella blanket policy on multiple properties, and the subject property for the all-in-one is in there, right? It depends on how it's written. Whoever asked that question, send me the binder, the policy binder. Let me take a look at it and I'll try and get you an answer quickly. I don't know. I gotta see it. Sorry.
Let's see here. We'll just keep track of that and then maybe we can connect with Kevin and you can ask that question. You guys
Cool.
can get to the bottom of it. Does the mortgage balance and effectiveness of reducing interest accelerate the balance as the balance gets smaller over the years?
Say it again, please.
Does the mortgage balance and effectiveness of reducing interest accelerate the balance as the balance gets smaller over the years?
Yes. Yes, because remember, it's based on daily, every day. So the lower that balance gets every day, every month, every year, it's a snowball effect. If I'm understanding the question, yes.
Yep. If economic factors change, are there risks of the all-in-one line of credit being closed or minimized? That's a great
Good
question.
question. Very good question. The answer is yes. To the extent that I think what you're asking is that let's say that when you get this loan, the value of your home's $1 million. And let's say that, God forbid, something happens. Chances are this person's talking about 08, 09, right? The housing and lending implosion, Simo implosion, where, I'll give you a fun story real quick in closing. I purchased a property in Florida, an investment property in Florida, 1.25, I think was the purchase price. I couldn't short sale that mofo for 300 grand. Okay. Those were very, very, very unique times that come with very specific markers, historical. I don't think we'll ever be in a situation in this country again. I think the knee-jerk reaction to what happened there has set up enough safety nets that it would preclude that ever happening again. However, to your point, you're never going to have access to equity that no longer exists. And there are routine, like if you're in a market, the property address is in a market where there's been massive decline in value, massive decline. By massive, it's probably, I think that the marker is 30% or greater decline in average value. They'll look at that property and see if that holds true. What would happen in that case is that any limit that you started with will be reduced accordingly to accommodate the change. So the easier way to repeat that would be, you're never going to maintain equity that no longer exists. They will reduce line limits based on some of those variables and factors.
Historically, over the last 10 years, have you seen them do that much?
No.
Yeah, it's been rare as of late, for sure.
Very, very, very rare. And even, when back in, because this product was available in 0809. And they would freeze lines, right? Now, here's what I would say in response to that, and they may not love my saying this, but if there's any writing on the wall, you guys, that would otherwise say that values are going south, and I had room, let's say that my limit was 500,000 and I only owed 250 at the time, but I got a sense that my value may show some substantial decline in the coming months ahead, I would draw every cent out of that line of credit so they couldn't reduce my line. I would take those funds and apply it somewhere for a return, obviously. But that way, what's happening is they're just going to freeze me at that level, right? Whatever my balance is, and then repayment of some of that if they were reducing the line. But I would grab that cash if those circumstances were relevant.
Yeah. Kevin has a question. It may be something that you want to connect with him separately. It might take a one-on-one, but his question is this. He doesn't understand how the principal pay down works if it's interest only. Being interest only, then wouldn't the actual payment amount be lower than what we're currently paying?
So Kevin, what's happening here is right here, if you can see my screen again. So this number and this number, actually, this number, 26,000, is a payment. Okay, every cent of this is like a payment because it's being left in there for 29 days. Okay, then what's left over is this and this. So this is a payment that most of which goes away, but these two numbers are being left in there, 7,800 and 1,902. So while you have 24/7 access to them, the assumption is those are just sitting there, right? Those are payments. Every cent that you put into the account works as a payment.
Yeah, we're not paying interest on that money that's left untouched.
Right.
Yep. So with that being said, I think, maybe Chaley, just in the 10-second overview, like if you had to describe the kind of borrower this is really designed for, how would you do that?
The easy math I would give you is that for those individuals that have at least 10% discretionary income at the end of the month are probably worth considering or running the math of the all-in-one. If you have less than 10%, unless you're high wage earners and you've got a lot coming in that's driving that down on the daily, under 10% may not be, I wouldn't preclude you, but I run the numbers no matter what, but I would say more often than not, 10% of what's left over after everything goes back out the door is kind of a primer or marker to those individuals that are usually on the qualified side of the spectrum.
Mm-hmm. So the kind of borrower who puts some money in savings for a rainy day and or might have access to lumps of cash from investments coming in that they can put to work for them in their mortgage.
Well said, Michael.
Okay. So Randy's got a great question here. He said, sorry if you discussed this previously and he missed it, but what are some of the methods others have used to automate their payments to one day? Often mortgages and things like credit cards have different due dates.
Good. So you've got a couple of options here. One, you call the creditor and change your due dates, which they're usually pretty accommodating for, right? You can change them to try and get them all on that same day. However, you're using that arbitrage of the credit card, so it really doesn't matter when they're due because you're using a credit card to make those payments. Now, what you may be talking about is mortgages in particular, more often than not, will not take a credit card as a form of payment. So what you're going to have to do in that case is A, change the due date, okay, to the same date that everything else is going to be, the credit card's going to be paid off, or you can go get a signature line of credit from Wells Fargo, B of A, Chase, etc. A signature line of credit is similar to a credit card, but different in that the mortgage will allow it. They'll allow you to use that as an ACH to make that payment, but it's still open-ended and revolving, and you just pay it off the same way as you would a credit card. So one of those two things or a combination of those two things is what you need to do to accommodate for maximizing the deposit sitting as long as possible.
Awesome. Any last questions? Otherwise, we're going to wrap it up.
I have a quick question. Do we have to structure the investment properties and how their business bank accounts are attached to them to do this for business investment?
So, okay, and I might need you to say that again because this is your new account. So are you saying that you're going to keep an existing, like an LLC account that is specified for the rental properties and you're going to slush the funds back and forth for accounting purposes? Is that what you mean?
Yeah. Yeah,
Okay.
especially if we want to do that cross collateralization for AIO.
Okay. And so, and say the primer or the question again was, do we have to structure what differently?
Just how we are structuring our LLCs and how the money is flowing between their accounts.
No, I mean, I have thoughts on LLC structure. If it were me, starting over again, I would only use Nevada, Wyoming, and Delaware LLCs. Um, that's a whole nother conversation, but no, they don't need to be structured any differently. And if for accounting purposes you want to do it the way that you described, the monies are going to go into the LLC account, right? Well, let's say the rents, gross rents are going to go into the LLC account. You are going to have to manually take it from there and then drop it into the all-in-one account same day, as long as you've got a record of it going in there for those accounting purposes. And then you let them sit, let them sit, let them sit, let them sit. And then on the last day of that month, when you need to put them back in again for accounting purposes, so you have that that time where the funds are sitting idle. Is that what you were asking?
Just one more clarification. So the
Sure.
AIO will be an account that would be held by the Wyoming management?
No, the all-in-one cannot be an entity. I
Mm.
believe people are doing this, but the all-in-one is going to be your individual name. Yeah, no, I'm sorry. Let me say that again. The bank account, the FDIC bank account and the mortgage are going to be in your individual name. If you were to
Okay.
decide to transfer title of that property, that real property into an LLC name for asset protection, for anonymity, the loan documents that you signed say not to do that. I know that there are investors out there doing that. That's for you to decide. But the banking part of it will be in your individual name. If you want to keep an LLC for those funds and accounting for your CPA, there's going to be a separate account with B of A or Chase or even Merchants or North Point. Those are the two FDIC banks that hold this mortgage, Merchants or North Point. Those are the two that pick up the servicing rights. You could probably establish its own checking account, and then it may make it a little bit easier to transfer from here where it starts into the all-in-one if you needed to do it that way. But it's an extra manual step if you didn't want to just drive everything immediately into the all-in-one account.
Got it, got it. And so what I like to do instead of putting it in my name, or sorry, putting putting the property in an LLC is to put it in a trust. So
Okay.
can the trust can we have a trust hold the AIO?
Yes, the trust, yeah,
Okay.
trusts are acceptable within the guidelines of the all-in-one. The account and the loan and title can all be in a trust name as long as it's been approved. We have to put it through legal, right? It's got to go through our attorneys and make sure it's approved. And one of the primary objectives would be it has to be a revocable trust. Non-revocable will not be considered as eligible for this.
Cool. Thank you so much.
You're welcome. Thanks for the questions.
That revocable, non-revocable trust is pretty standard across all mortgages, right?
Yeah. You're not going to get any institutional lending to allow a non-revocable trust. It just means that in the event of default, they can't attach the assets. So that's never going to happen.
Right.
There's other little tidbits in language, even in revocable, that could be problematic. I mean, it's just the way that it's structured. But more often than not, if it's a revocable trust, chances are it's good. We just got to take the entire document, run it through legal, get it approved, and it should be fine.
Last couple questions, then we got to bounce. This has been great. But one question from Kevin here is, what if all the properties are currently in a business entity name?
The subject property, Kevin, the one that is going to be attached, or the all-in-one is going to be used for, cannot be in an entity name. You have to close it in your name. Title and the loan will be in your name. If you chose, Kevin, at your discretion, without my advice, to put it into, use a quit claim deed and put it into an entity after the fact, that would be on you. I mean, worst case scenario, you could have the servicer come back and require that you take it back out. And that whatever costs of doing that are associated with that would be on you.
Is a land trust revocable?
No, it's not the same kind of trust. Send me the document. I'll look at it. It might be acceptable, but I need to, I don't know. I got to look at it.
Sweet. So guys, for anybody who's interested in the program, what we or meeting with Shaylee to do one-on-ones, what we do is we ask you guys to go through the master class, which has some podcast episodes, Q&As, some great content to teach you a little bit more deeply about the program. And at the very end of the master class, there is an opportunity to directly connect with Shaylee to book a meeting right on her calendar, where she can walk through your simulator results with you. As a final closing thought, we're going to be sending out the recording for this to everybody on the call. And anyone who has worked with us or can validate that you have an all-in-one mortgage, we will also send you an invitation to our brand new all-in-one exclusive community.
Cool. And then just real quickly in closing, how to reach us, ridgelendinggroup.com, email info@ridgelendinggroup.com, or toll free 855-747-4343, 855-74-RIDGE.
Thank you, guys.
Thanks, guys. Appreciate you being here. See you soon.